Hello, this is Kate. I'm going to walk you through the Class 6 in-class exercise. So this problem has two parts. First, I'll walk you through the calculation of the current and deferred federal and state provision and the respective journal entries, and then there'll be a change of facts, and we will recalculate the provision, and from there come up with the return to provision journal entries. Alright, so to calculate our state payable, let's start off with calculating our state blended rate. And this is really just as simple as multiplying apportionment times rate to get a blended rate. And because of the simplicity of our facts, we're kind of able to just aggregate all of these blended rates into one general state rate. So let me just finish this up really fast. So our Tennessee apportionment is listed as 20% per the facts. The state tax rate for Tennessee is 7%, again per the facts, and the blended rate I'm calculating 1.4%. So if we sum this all together, I get 6.5. And again, this is essentially the rate that income will be taxed at in aggregate in all of these states. So $1 of income will be taxed at 3.9% in Michigan, 1.2% in New Jersey, and in total 6.5%. Alright, so let's get started with our current state provision. So we have 5 million of profit before tax per the facts. We have $50,000 of non-deductible penalties. We know that's a permanent add back. We're going to have a permanent add back for M&E of $40,000. Our ISO expense, or our incentive stock options, will be $70,000 permanent add back. So I think that sums up our perms. Now on to the temporary adjustments. We have bad debt reserve. We know that book is expensing something that will deduct later, so that's going to be an unfavorable adjustment. It's another $45,000 add back. Let's see, book depreciation. This is going to be an unfavorable adjustment as well. We have book depreciation in excess of tax depreciation, so it's unfavorable. That is $300,000. Oops, I missed one. So the last one is we have our non-qualified stock option deduction, and that is listed as $35,000. So I think that's it. Then we're able to calculate taxable income, 470, and this is our state current provision. So we're going to apply our state blended rate. So we have the 6.5% that we calculated earlier, and that will be $355,550. Oops. $355,550. We're not quite done. The facts list out a Michigan R&D credit, so that will reduce our tax by $45,000. And I'm out of room, so I'm going to take it up here. So our total state current payable is going to be $310,550. Alright, so now let's calculate our deferred provision. This is going to be step 2. So we had step 1, step 2. Let's see. So we're trying to determine what our change in deferreds is, and this is going to be driven by our timing items. So our timing items from step 1 are going to move over to step 2. Well, the first one is the bad debt reserve. Oops. There we go. And so this was an add back for the current payable. We know that we have a future deduction of $45,000 for a bad debt. So this is going to be a deferred tax asset. Similar for depreciation, we know that we'll have a future deduction since it was unfavorable for us in the current year. And so that is going to be a DTA of 300. There we go. Okay. And so now we need to think about our non-quals. We know that we had a current year deduction of $35,000. But per the facts, we also know that there was a previous expense associated with this option, and that previous expense was listed as $60,000. So what we know is that the DTA was set up for this option of $60,000, and since the option has been exercised this year, we know that this DTA needs to go away. This option no longer exists. We need this off of the books. So this needs to be reversed, the full amount of the option. But as you can see, there is a discrepancy between the amount that we've deducted and the amount we're reversing for the DTA. In fact, the deduction is less than the amount of DTA that we had, so this is going to result in a shortfall. So the remaining amount, the difference, is the $25K, and we know that's going to go to APIC. But, oops, for purposes of calculating our deferred provision, we would aggregate these amounts. We have a net DTA of $285, and then of course we need to tax affect it by our blended rate, so 6.5, and that's going to get us $18,525. Alright, so now let's put together our journal entry. So first we're going to credit our payable. Let's see, credit, payable. This is our state payable. This is going to be the amount we calculated in our current payable calculation. So this is 310, oops, 310, 550. And just note that there will be a federal effect of this because we get to deduct the state tax we pay for federal purposes. Alright, so next we debit our DTA. DTA. And we just calculated this amount to be 18,525. And so remember I mentioned that there is this discrepancy between the deferred tax asset and the amount of the current deduction that we were taking for the non-qualified stock options, and we know this amount to be $25,000. So we tax affect this amount by the 6.5%, so 25,000 times 6.5 equals 1625. We're going to debit APIC by this amount, 1625, and the remaining amount is going to be our expense. We have expense of $290,400. And there it is. Alright, so now on to Fed. And we can shortcut this a little bit because we've already calculated taxable income for state purposes. And the only difference based on our facts is that we're going to be deducting state taxes for federal purposes. So we can start with the 5.47, and remember this was our taxable income, taxable state income from earlier. And we calculated our current state payable to be, there we go, to be 310,550. So we know that's deductible for federal purposes. There we go. So that gets us to a federal taxable income of $5,159,450. Our federal rate is 35%, and that gets us a federal tax of $1,805,808. We're not quite done. We have a R&D credit of $50,000. And so the amount that we would owe on our federal tax return is $1,755,808. And that's our current payable. Alright, so we've just finished our step 1, our current payable. Now on to step 2, the deferred provision. And this is going to be fairly similar to our state deferred provision. Once again, we know that we have the $45,000 deferred tax asset for the bad debt reserve. Additionally, we have $300,000 for depreciation. We have a future benefit associated with our fixed assets. And also the same as state, we know that we had previously had an expense related to this non-qualified stock option of $60,000. Yes, we've taken a deduction of $35,000 for it in the current year, but since it's been exercised, this DTA can no longer be on the books, so we know we need to reverse the entire amount that was expensed. That is the $60,000. And so the one item that we didn't have for state that we're now going to have for Fed is our state taxes. So it's going to be the deferred tax asset from earlier that we calculated for states. So what you need to be thinking about is that if all things were equal, if we would save on future state tax, then we're getting less for federal purposes. So basically it's going to have an opposite effect on Fed. What happens at state will have an opposite effect on Fed. So we just need to flip what we calculated for state purposes. So that was the 18,525. And this is going to be our deferred tax asset. It's going to be a net 266,475, and that's our total future deduction for federal purposes. Let's tax affect it, 35%, and that should be, based on my calculation, 93,266. 266. Okay, so now let's put together our entry. So first, credit payable, and this is going to be the, let's see, 1,755,808 that we calculated. 1,755,808. Oops, I lost it. 808. Okay. And we also just calculated the DTA. So we're going to want to debit our deferred tax asset, the 93,266 we calculated. And so for APIC, we need to keep in mind that this DTA has reversed out the federal effect of state. So we need to make sure that we're incorporating that in our APIC entry as well. So rather than just being the $25,000 tax affected, we need to back out the state piece as well. So I'm calculating my APIC entry as $25,000 minus the, minus the 1625 that we calculated for state. And then of course, tax affected at the federal rate. So that's 8181. So again, that's 25,000 minus the 1625 times 0.35. Okay, and again, that's just to account, the APIC entry is just to account for our shortfall. We had a discrepancy between the amount of the DTA that we're reversing and the amount of the current adjustment, so the current deduction related to the option, so the remaining portion needs to go to APIC. Alright, and then to balance, we have our federal provision, and I'm calculating that, provision, expense, so I'm calculating that to be 1,654,360. Okay, so in part 2 we have new facts. We have let's see, we have new apportionment percentages, and then we have new balances for some of our book to tax adjusting items, and then we also have a new R&D credit for Fed. So I've put our previously calculated state tax payable over to the left here, and I'm just going to show the items that are changing. So it looks like our, let me just see real fast. So we have non-deductible penalties. This one right here is going to 40,000. And we have depreciation is going to 280. And I think that's it. I think those were our only two items there. Yeah, just our credit. Okay. Alright, so then everything else can come across. We got the 5 million here. We have 40 again. Whoops. 40. And we have our 70 again. So this is our new payable calculation. And then we have, same as before, our stock option deduction of 35. So I'm calculating this to be 5,440. 5,440. Okay. So after trips, I'm calculating a payable of 5,440,000, and of course this is for state. So the problem is we have a slightly new rate. So let's just calculate our new rate off to the side. This should be fairly straightforward. We have 60% apportionment times 6%. That's going to be 3.6. We have 8%. Oops, 20% apportionment in New Jersey times 8%. That is going to be 1.6. Oops, I messed it up. 1.6. And finally, Tennessee, 20 times 7. It's going to be 1.4. So our aggregate blended state rate only changed slightly. It's 6.6 now as opposed to, I think, 6.5 before. Okay, so this is the rate we're going to want to apply to tax effect our current payable for state. So 6.6, and I think, let's see what that gives us. I think it's going to be 359,040. There we go. Okay. Okay, now let's do our revised state deferred after trips, and this is going to be easy as well. I cleared the screen, but we're really just dragging across our temp items. So we have our, 45 for the reserve, bad debt reserve. depreciation change, so it's now 280. And then we have the same 60 as before. Again, this is just our DTA reversal for the exercise of this option. That's going to get us to 265. And let's tax effect this at our new rate of 6.6. Oh man, okay, 6.6, there we go. And I get 17,490. And that's it. That is our state deferred, or net DTA for state purposes. Okay, let's put our entry together real fast. So credit payable, we just recalculated this amount to be credit of 314,040. We just calculated our DTA to be 17,490. And we need to recalculate this APIC amount based on our new tax rate. And so that's going to be $25,000. The amount from the fax itself hasn't changed. But at our new rate of 6.6, I get $1,650. And let's see. To balance, I'm getting a provision of $294,900. Okay. Okay, on to Fed. Alright, so again we can shortcut. What did we say our revised state taxable income was? We said it was 5,440. And again, the only difference based on our facts that we're calculating is going to be state taxes. And so this is going to be our revised state current payable amount. So that is the 314,040 we just calculated, and this is going to be deductible for federal purposes, and that should get us to our federal taxable income. This is our new amount after true-ups. 960. Okay, and I think we have a revised credit number, by the way. So first let's calculate tax. So we have 1,794,086. Our new credit amount is 48,000. So the amount we're saying we paid on tax return is actually 1,746,086. So I don't have my current calculation up to the left, but if you remember, so let's do our step 1 here. So that's our current. Now we're on to deferred. Nope, that's not going to happen. Okay, all right. So we have our $45,000. Why is this not working? $45,000. There we go. And our revised amount for, so this is our $45,000 deferred tax asset for bad debt reserve. So our $280,000. Remember, this is a revised number for tax depreciation, or rather the future benefit for depreciation. So that's another DTA. Then we have our same $60,000 reversal of the stock option. This is the reversal of the DTA that was previously set up for the non-qualified stock option that's being expensed or deducted in the current year. And then we can't forget about our reversing out the state taxes. So we've just recalculated this amount to be 17,490. Okay, and so all of this together gets us 247,510. This is our net DTA for federal purposes before tax effect. All right, so 35%, 86. So here's our net amount, rather, 629. Okay. Okay, let's put together our journal entry for Fed. So first we're going to credit our federal payable. And that's going to be the 1,746,086 we just calculated. Okay. Now we're going to debit the DTA. And that is the 86,629. Okay. And so now, in order to get our APIC entry right, we have to consider two things. First, the offset to the federal DTA for the award, and then the second is the federal effect on the state deferred. So remember when we previously calculated this amount here, this 86,629, we reversed out the 17,490, or the state deferred. This amount includes the entire $60,000 tax affected, and we haven't accounted for the federal effect on APIC yet. So therefore, to get our entry right, I'm calculating this as the APIC entry as $25,000 less the amount we calculated for state, and then multiplying it by 35. So that's going to be $25,000 less the $1,650, right, at our new state tax rate, times 35. So I get 8173 APIC. 8173. And then finally, to balance, we have our provision. Debit 1651 285. And there it is. Okay, now we're ready to calculate our return to provision entry. And this is really as simple as taking our previously calculated amounts from step 1, or I guess part 1 of the problem, then taking our newly calculated amounts or on the revised numbers, on the trued up numbers, and then the difference will be our RTP entry, and it's really as simple as that. So I've pulled the numbers that we had from earlier in the presentation from part 1, maybe summarize them a little bit. So we have our federal payable, our state payable, and then the total deferred, our income tax expense, and then APIC. And so we've just recalculated these amounts, and so I'll summarize them below. So we have our new current payable is 1,746,086. Our new state payable is 314,040. Our new deferred is 104,119. Expense 1,946. 185, and then finally APIC 9823. Okay, and so really just finding the difference here. So we have a decrease in the payable. So our payable went down, therefore it's going to be a debit to payable. Less liability. Our state payable went up, so we're going to credit payable 3,490. Okay, and our DTA went down, so it's going to be a credit 7,673. Expense went up, it's a debit. Oops, 1,4. then finally, APIC increased just a little bit, 16. And that is our RTP entry.